A reg tests federal tax procedure by asking where the taxpayer is in the IRS process, what options are available, what penalty may apply, and what authority supports the tax position. The main skill is identifying the procedural stage, the taxpayer's choices, and the consequence.
In Reg Area 1, you're rarely tested on just memorizing definitions. It's all about application. When you're looking at federal tax procedure scenarios, the questions evaluate very specific decision points. Examiners want to see if you can pinpoint exactly what IRS stage is involved and whether the taxpayer has already paid the disputed amount. You need to know which court option is available based on that payment posture, what taxpayer penalty might apply, and whether there are specific defenses available, like reasonable cause, proper disclosure, or sufficient authority. Finally, you have to determine what authority carries the most weight in a disagreement. If a taxpayer receives a specific notice, you must immediately know what legal doors just closed and what doors opened.
Think of the IRS process as a strict chronological timeline. It moves step by step, starting with return filing, then potentially an examination or an audit. Disagreements move to appeals. If the issue remains unresolved, it heads to the judicial process. And finally, it ends with assessment and collection. Timing is critical for the exam. Skipping steps or missing deadlines irrevocably changes a taxpayer's legal standing. A taxpayer's options are completely dependent on their specific stage and the exact notices they've received at that exact moment in time.
So, during the examination stage, the IRS is essentially verifying the accuracy of a tax return. You'll generally see two primary types of audits tested. They might conduct office examinations, which are typically for straightforward substantiation issues, or field examinations, which are used for much more complex corporate or business situations. The examiner makes information requests to support the claimed items and then proposes adjustments based on their findings. At this point, the taxpayer has a clear choice: agree to the adjustments and pay up, or disagree, which triggers the next formal phase of the process.
Now, a really critical distinction you'll see tested is the difference between the 30-day letter and the 90-day letter. If you disagree with an audit, the IRS issues a 30-day letter. Ignoring this letter means forfeiting your administrative appeal opportunity. On the flip side, the 90-day letter, also known as the statutory notice of deficiency, legally controls your 90-day window to petition the U.S. tax court. This notice is a formal legal determination by the IRS that additional tax is owed. Missing this 90-day window changes your legal options entirely.
Well, if the taxpayer responds to that 30-day letter, they go to administrative appeals. You have to remember that appeals does not perform a second audit. Instead, they hold an informal conference focused primarily on settlement. The appeals officer's goal is to settle the case to save the government the cost and risk of actually going to court. They base their offers on the hazards of litigation, meaning they mathematically weigh the probability of the IRS winning or losing in court. While new information can definitely affect the case, the main goal here is a fair resolution without a trial.
Okay, let's say settlement fails and a 90-day letter is issued. Now we enter the judicial process. The major divide in court options really comes down to your payment posture. The tax court is a deficiency court, meaning a taxpayer can litigate without prepaying the disputed tax. Conversely, refund courts strictly require the taxpayer to pay the assessed tax in full first, file a formal refund claim with the IRS, and only sue after that claim is officially denied.
For the U.S. tax court, that 90-day statutory notice of deficiency is the required trigger to get in. This court hears only federal tax disputes, and there are no juries. Cases are heard by a single tax specialist judge. Although based in Washington, D.C., these judges travel nationwide to hear cases. Because the judges are tax specialists, taxpayers with highly technical tax code arguments often prefer this venue, which is a very common exam testing point. Plus, it remains the preferred route simply because it doesn't require prepaying the tax liability.
But what if the taxpayer has already paid the tax and is suing for a refund? You've got two options here. The U.S. District Court hears general federal matters. Here's an instructor-level tip for the exam. If a scenario mentions that a taxpayer wants a jury of their peers, the only option is the district court, and therefore they must prepay the tax. The other option, the U.S. Court of Federal Claims, is based in Washington, D.C., has no jury, and specifically handles claims against the federal government. It's really important to cleanly distinguish between assessment and collection. Assessment just formally records the tax liability on the IRS books. Collection is the actual administrative pursuit of that unpaid tax, like sending bills or levying assets. Assessment must precede collection. Timing is vital here. Missing a 90-day tax court deadline leads directly to formal assessment and collection. This completely eliminates the deficiency court option, meaning the taxpayer is now forced into the refund court route and has to come up with the cash to proceed.
Let's shift gears over to taxpayer penalties.
Firmly remember, these are entirely separate from preparer penalties. Reg Area 1 questions will intentionally mix preparer penalty distractors into taxpayer penalty questions just to test your focus. Taxpayers face penalties for non-compliance, such as failing to file a return, failing to pay the tax due, careless errors leading to accuracy-related penalties, or intentional fraud. Knowing exactly which taxpayer penalty applies to a given scenario is a core decision-making skill for the exam.
When comparing the primary non-compliance penalties, the failure to file penalty is a hefty 5% per month of the unpaid tax. The failure to pay penalty is much lower, at just 0.5% per month. Both cap at a maximum of 25%. A heavily tested concept is how these two interact. The failure to file penalty is actually reduced by the failure to pay penalty in any month where both apply. Additionally, if an underpayment involves fraud, the failure to file penalty jumps to 15% per month. Filing on time, even without payment, prevents that 5% monthly charge.
How do taxpayers defend against that 20% accuracy-related penalty? Well, you can demonstrate reasonable cause, provided you acted in good faith without willful neglect. Another defense is proving the tax position has substantial authority, in which case disclosure is not required to avoid the penalty. However, even if the position falls short of substantial authority, the penalty is avoided if the position meets the threshold of a reasonable basis and is adequately disclosed on the tax return. Disclosure is mandatory when you're relying only on a reasonable basis.
To figure out if you actually have substantial authority, we use the tax authority hierarchy. On the exam, you might be asked to rank these items from highest to lowest authority. The Internal Revenue Code is the highest statutory authority because it's enacted directly by Congress. Next up are Treasury regulations, which serve as the official agency interpretation of the code. Below that are court decisions. Further down is administrative guidance, things like revenue rulings and revenue procedures. Finally, IRS publications and private guidance carry the least authoritative weight in a dispute.
A really common exam mistake is assuming one IRS ruling ensures a win. A single revenue ruling might support substantial authority, but it does not automatically win every issue. The IRS's own administrative guidance, like a revenue ruling, is treated as the IRS's argument in a dispute, not binding law. This is why courts can and do overrule them. You must evaluate the combined weight of all relevant authorities to see if they genuinely support your position over the IRS's position.
Let's put this into practice with a quick scenario. Taxpayer A receives a 90-day letter for a proposed $15,000 adjustment. She wishes to litigate but cannot afford to pay the $15,000 up front. What are her options? Take a moment to evaluate her payment posture and the specific notice she's holding.
Because she's holding a statutory notice of deficiency, the required trigger is met. However, since she can't prepay the tax, the District Court and the Court of Federal Claims are completely off the table. Therefore, the U.S. Tax Court is her only viable judicial path. She has to file her petition within that strict 90-day window to avoid formal assessment and collection.
Let's try one more. Scenario 2, taxpayer B is assessed a 20% accuracy-related penalty for a $4,000 understatement. He relied on an IRS publication and adequately disclosed the position, which has a reasonable basis. Does the penalty hold? Notice the specific keywords the exam question is feeding you here: IRS publication, adequately disclosed, and reasonable basis. We are evaluating authority, disclosure, and penalty mitigation. The result, the penalty is avoided. While an IRS publication is essentially just an informational booklet and carries very low authoritative weight on its own, the combination of a reasonable basis and proper disclosure on the tax return is the specific statutory formula to mitigate the accuracy-related penalty. Meeting that standard protects the taxpayer.
Let's rapidly run through some common exam traps. First, don't choose a court option without checking the payment posture. Remember that refund courts require upfront cash. Never confuse the administrative 30-day letter with the binding 90-day letter. Don't mix up appeals with litigation. Appeals is an informal settlement conference, whereas litigation is a formal binding court process. Do not mix taxpayer penalties with preparer penalties. Never treat all tax authorities as equal. Don't assume one revenue ruling proves substantial authority, and remember that disclosure fixes a reasonable basis position, not a frivolous one.
Federal tax procedure questions become easier when you identify the stage, options, payment posture, penalty rule, and authority.